Hello and welcome to this overview of the Series 7 exam brought to you by Passing Score, where you can get more help on your exam prep at passingscorefinance.com. In this video, we'll be going over the market section of the exam, starting with a primary market. This is where the issuer or corporation is first selling their shares out to the public. And they're doing this with the help of an underwriter or a syndicate of broker dealers that are providing distribution out into the market. Once they're sold into the market, the shares are traded on the secondary market. These are simply trades between investors and dealers on the OTC or on the various exchanges. Next, we have the third market, which are still exchange listed securities, but they're traded over the counter between a broker-dealer and a large institution. So these are generally going to be fairly large trades. And we also have a fourth market, which are exchange listed securities, but traded without the help of a broker-dealer. So between large institutions, private parties. And because they don't go through a regulated broker-dealer or an exchange, they're not subject to reporting requirements. We also have something called a dark pool. These are trades that are facilitated by broker-dealer firms for their clients, and they basically match trades between their clients. This provides an anonymous way for the investor to buy and sell shares without letting the market know that they're doing so. And this also avoids the problem of price impact. This means that the shares don't go up in price or drop down in price sharply when you're buying and selling the shares. This is helpful for the investors, but it does cause some issues in terms of making the markets less transparent. You can't see what's going on. You don't have good price information on shares, and it can provide unfair benefits for certain investors over others. So it doesn't leave a level playing field. Another thing you should definitely know about are different types of price quotes. We have bids that are offered to buy, asks are when you're selling the shares, and the spread is the difference between the bid and the ask price. There's different quote types as well. A firm quote is the default setting. So if you make a quote and don't specify, it'll automatically be registered as a firm quote. This is a specified price on a firm order to buy or sell shares. You also have the option to do an out firm quote. This sets the price, but only limits it for a certain amount of time. So it provides you a little bit more flexibility. There's also other types of quotes that you should know for the exam. The subject quote is subject to confirmation. The workouts, bid wanted and offer wanted also allow you different types of flexibility. There's a lot of acronyms out of the market, and here's some key ones. The OATS system is a way for FINRA to monitor orders and quotes. Trace allows FINRA to trace transactions on the fixed income side. The CQS is a quotation service for exchange listed and OTC securities. And there are ECNs as well. These provide quote information for exchanges and NASDAQ securities. Let's get into the settlement date. This is when a trade is actually cleared. So we have the transaction date, and a few days later, the settlement is made between the cash and the security. Uh, we have 3 business days for stocks and bonds. So this will be shown as T plus 3. We have T plus 1 for treasuries and options, and then T plus 0 or same day for cash types of transactions. There are some exceptions to those settlement dates. In some cases, we're allowed to deliver a little bit longer than the normal for that type of transaction. We have a special settlement, which allows you to settle the second business day from the trade date. and corporates on the third business day. Uh, when you're listed on the NYSE, there are certain requirements. So not just any firm can get listed just because they're a corporation and have shares. So you have to be a pretty good size. There has to be national interest in your company, and there are minimums for the market value, number of shareholders, the trading volume, and earnings. And the company has to operate in a certain way, including soliciting proxies. There's also rules for delisting from the NYSE as well. There has to be approval from the board, a press release announcing what you're going to do, and a written notice to 35 or more of the largest shareholders. There's certain rules that members have to abide by as members of the NYSE. Uh, there's certain things like not manipulating the stock or spreading rumors. And there's rules around the trading halts and making sure that the prices on your orders are actually binding. The only exceptions are when there's an error on the number of shares. Sometimes people type an extra zero at the end or some other mistake like that, and they're not necessarily going to be tied to that trade. There's different types of members of the NYSE. We have a commission or floor brokers that work on behalf of a member firm, $2 brokers who work for other brokers. Competitive traders or floor traders are trading for their own accounts, so they're proprietary. They're trying to make money for themselves. And then specialists, which facilitate, which they help make the market for a certain stock. Specialists have certain obligations, but their main purpose is to maintain a fair and orderly market for a certain stock that they're assigned to. The order ticket has to have certain information, whether it's a buy or a sell, long or short, a lot of information that you would expect, including the account type that it's for. And there's certain process that has to be maintained as well, beginning with filling out the customer instructions, all the way through to the cashiering department receiving the funds and the securities. There's different order types as well. There's market, which is to execute immediately at whatever the price is in the market at that time. Limit orders, which are looking for a certain price or better. A stop order, which is going to execute after a certain price is reached. And then a stop limit, which is a combination. The stop order becomes or converts into a limit once that specified price is reached. There's also different qualifiers to control your trade a bit better as well, to make sure it's not trading beyond what you intended. So you can have a day order, which is an order just good for that day. It's going to be canceled if it doesn't meet the requirements. This is the default setting that's going to be assumed unless you specify one of these other types of qualifiers. And these include all the way through to immediate or cancel, a not held qualifier. There's different types of access to NASDAQ pricing. So you can have access to real-time quotes, but not for what the market makers have for their bid and ask prices. You can only see the highest bid and the lowest offer, but not all of the activity. All the way to a level 3 access, which is giving you the real-time quotes as they're happening for everyone, including the market makers. And this type of access is only for registered market makers. There's different types of NASDAQ markets. You often hear the NASDAQ 100 being quoted, but there's also sub-markets that focus in on small cap stocks, global trades, or the global select market as well. So they're not just one type of NASDAQ. They break down into different specialties as well. That's it for our overview of the market section of the exam. If you have any questions, please feel free to email me at john@passingscorefinance.com. And as always, good luck on your exam.